All right. Welcome, everyone, to Financial Fridays with Sanies and Equitable. Today's topic is tax time, and Sanies is very excited to offer these Financial Friday sessions in cooperation with our corporate partner, Equitable Advisors. And before we begin, we will hear a few words from our sponsor, Equitable.
A large financial firm and been a strategic partner of Saney's for the last 10 years. In that, we've had a commitment to the K-12 marketplace, making sure that educators are educated about their finances. We've been able to give those members additional support that's needed to make some of the biggest decisions in their life, like preparing for their retirement and their kids' college education. When an Equitable advisor meets with a Saney's member, what our objective is to give them the confidence that they need going into retirement, making one of the biggest financial decisions they'll ever make in their life, to best assist them prepare with whatever their financial goals are. Equitable provides Saney's members includes financial resources and articles, complimentary financial profile meetings and an asset map, professional development educational webinars to units, and then in 2025 we're going to be doing a Ready to Retire series for people that are at least 1 to 3 years out from retirement and want to know how to finalize next steps. One of the benefits of being a Saney's member is on the first Friday of each month, we've always provided a Financial Friday series. It's a 30-minute series that goes from 12 to 12:30 that's presented by local regional representatives at Equitable that manage each region within Saney's on a variety of topics, including planning for the future, student loan forgiveness, and healthcare and retirement. What I would want Saney's members to know about the Equitable relationship is that you're going to have questions that come up, and there's always a tremendous amount of resources. There's an email address, saniesmembers@equitable.com, that can be utilized, and there's always somebody on the other end of that email address to address any questions, comments, or concerns. Best time to plan for retirement is today. Looking at the future immediately or as soon as you're able to, realistically, you're going to be best prepared for that future. Sometimes, if people haven't looked for the financial future yet, minimally 7 to 10 years out from retirement, that threshold absolutely must start because you still have time to make effective change, tweaks, and adjustments to your financial situation to best be prepared. The most important message for Saney's members to know is that Equitable Advisors is there to help them as life comes up. It is normal and it's going to happen where there's questions, concerns, things you're unsure about, and you've got a tremendous amount of resources to help and support you through that.
All right. Thank you, Kelly. And joining us from Equitable today is Luke Yanklowski. Thanks for being here, Luke. And just a reminder, everyone, the session is being recorded. We will save questions until the end of the presentation, but feel free to add questions to the chat or use the Q&A feature. And a reminder that the Q&A time is best used for general questions, but please know that the Equitable team is available at any time to answer your personal questions. You can find contact information for your regional rep at sanies.org. And I will turn it over to you, Luke.
Thanks, PH. Hi, everyone. Thanks for being here. This Friday, PH, just real quick, can you confirm you can see my screen? Perfect. Thank
Yes.
you. So today we're going to go through tax time. And I think there's one important distinction to make about what we're going to talk about today. We're going to talk about planning for taxes. So there's tax planning and then there's tax preparing. So preparing your taxes is taking your tax documents to TurboTax or H&R Block, your accountant, or whoever it is, and filing it. And they tell you this is how much you owe, this is how much you get in a refund. Planning for your taxes is a proactive approach to make sure whether it's in the next tax year or in future tax years, you pay a less amount to the IRS in the state. Because the reality is I am yet to meet the human being that just says to Kelly and I really want to pay more to the IRS this year. Like, no one ever said that. And if you plan properly, you don't have to pay more to the IRS. So just a quick disclosure, one thing that is important to note, we are not CPAs, we are not accountants. Okay. What I'm going to start by talking about are just the different ways to file. The reality is when it comes to taxes, if you want to pay less in tax, if you want to play the game and win the game and pay less, you have to understand the rules of the game. And the first part of understanding the rules of the game is understanding the brackets and how you file. So first, we're going to look at single filers. So as you can look on the right-hand side of your screen, effectively, these are the different tax brackets for single filers. Most folks on this call are probably going to fall somewhere between the 12 and 24% bracket. Most folks are probably going to have about 12,400 of income to about 201,000. Some folks might be beyond that, might be in the 32, maybe somewhere in the 10, but that's generally where most folks are going to be. If you look at single filers relative to married filing jointly, if you look at the tax brackets, if you just double the numbers, so I'll go back here real quick. If we look, we can see the 12% tax bracket starts at 12,400. If you take that for married filing jointly, the married filing jointly 12% tax bracket starts at 24,800. So a little secret is if you just double the single brackets, that's how you get to the married filing jointly tax brackets. Something that is important to note. So tax brackets have, or tax rates 10 through 37 have really stayed unchanged since about 2017. However, the income you have to hit the threshold for those brackets pretty much adjust for inflation every single year. So they're a little bit lower in 2025 and 2024, and they should go up a little bit in 2027, which is good. So as you earn more, your bracket is also, your threshold for your bracket is also adjusting a little bit. Now you have, so you have the married filing jointly, and you have single. There's also married filing separately, and I'll talk about head of household next. If you file married filing separately, generally speaking, there is really, really unique scenarios only when someone should file married filing separately. Married filing separately is something the IRS actively does not want people to do. You lose pretty considerable credits or tax credits, deductions, and you also significantly limit the ability to contribute to a Roth IRA. So just know if you are currently filing married filing separately or thinking about married filing separately, it's something that the IRS really puts some incentive in places to not do. And you just have to be mindful of that. Now, are there scenarios where it does make sense? Yes, there is. Sometimes they're related to student loans. Sometimes there's some other ones. But you just have to be mindful before you go and file if you're thinking about married filing separately. One of the things we run into is people will say, I'm married filing separately. And we say, great, how much do you make? $80,000. Awesome. Do you contribute to a Roth IRA? Yep, I put in $5,000 a year for the last 10 years. Well, if you filed married filing separately and you make more than 10,000, you're not eligible to contribute to a Roth IRA. So that person was contributing and the IRS finds out, they're going to have a huge tax penalty. So you just have to be mindful of some of these things and the pros and cons of the way you file. Then we get into head of household. Head of household effectively means you're unmarried and you're paying for most of the household expenses and you have some sort of dependent or dependents. What we find is folks are usually very aware of filing single or married filing jointly. They're less aware of some of the information around married filing separately and head of household. So usually if you take your tax information, you plug it into TurboTax or you take it into an accountant and they see you have a dependent, they should be asking questions, make sure you're filing head of household, not single, because as a head of household person, what that effectively means is you can make more money and pay less in taxes because the IRS effectively gives you a tax break because you have dependents and you're supporting them on a sole income. So this is the first step to be mindful of is how are you filing and are you filing correctly? I've had people that have dependents and I look at their tax return and they're unmarried, they have dependents, but they're filing single. And they've been doing that for years. And what they don't realize is that costs them literally tens of thousands of dollars of taxes because they just weren't filing correctly. So the first step in understanding and playing and winning the game of taxes is understanding how you currently file and how should you be filing. So we're going to look at a case study or example. So here we have Jane. Jane files her taxes as a single filer, makes about $58,000 a year. That would put her in the 22% bracket. Does she pay 22% on all 58,000? The answer is no. One of the biggest misconceptions around taxes is people think if I fall $1 into the next bracket, I pay that rate on everything. So you can see with Jane, the first 12,400 she makes in income, she pays 10% taxes on, or 1,240 in taxes. Every dollar she earns from 12,400 to 50,400, or that next $40,000 of income, she pays 12% taxes on. And then anything she makes over the 50,400, she pays 22% taxes on. So she's paying 22% taxes on only the last 7,600 of income. So again, probably the biggest misconception around taxes is people think if I go $1 into the next bracket, I pay that tax rate on everything. And it's a laddered system. You only pay that on the dollars over that bracket. So if I make $50,401, I pay 22% taxes on the last dollar, not all of it. This is where, though, you can potentially save yourself over time thousands of dollars in taxes. Because if I make $51,400 in a year, and I'm losing 22% federally on the last $1,000, can I do something to reduce my income by 1,000 and save myself 220 bucks in taxes? And if you do that every year for 30 years in a working career, you could potentially save yourself hundreds, if not thousands of dollars of taxes. So after looking at how you're filing, you have to understand to plan accordingly for taxes where about you're going to fall in taxes. Because then once you understand how you're filing and what tax bracket you're going to fall in, you can really start to figure out, okay, how can I get to a lower tax bracket and save myself? Right? Like if I'm going to pay 22% in that last 1,000, I'm losing 22 cents for every dollar I make just in federal. That's not even in the state. Other common things to know when it comes to taxes. First is standard versus itemized deductions. So every person in the United States can basically write off a certain amount of their income for taxes. If I am single or married filing separately, that amount is 16,100. If I'm married filing jointly, it's 32,500. And if I'm head of household, it's 24,150. So one of the benefits of head of household is I get an additional standard deduction. What this effectively means is that if we'll use the single or separate as an example, I can make $16,100 before I pay $1 in taxes. So there you can be in a 0% tax bracket if you make under that threshold. What that also means, going back a slide, before I hit the 12,400 bracket, I actually need to make 12,400 plus my 16,100. So I actually need to make about 28,000 before I fall in the 12% bracket. So people will sometimes say to Kelly and I'm nowhere near the 22 or nowhere near getting low enough to the 22 or 12% bracket. But once you factor in the standard deductions, what we'll go through next in some tax credits, and then pre-tax deductions, sometimes it's pretty reasonable to get somebody that on paper looks like they're nowhere near the 12% bracket back there, or from the 24 to the 22% bracket. Somebody can also itemize their deductions. This basically means they just add up certain qualifying expenses to see can they write that off against their taxes. It's relatively rare today, just given the changes to the standard deduction over the last couple of years and what you can write off. But it is It is somewhat common if you see people that are doing large gifts to charities. That's the most common space we find people are doing itemized deductions. Rare, but not impossible. Also talking about common tax forms. So everyone on this call, you should have received your W-2 from your employer. This is basically your income statement from your employer, or if you have multiple employers, you get multiple W-2s. There's also 1099s. This would show things like dividend or interest income and could show other miscellaneous income. Maybe you do some contracting work or something, you might get a 1099. 1098 will show your interest of your mortgage and your student loans is your most common one. And then your 5498, which I don't have up here, is basically something you get in May that confirms IRA or Roth IRA contributions. The last one would be your 1040. That's actually your return. Okay. So switching over from just how do taxes work to building a financial strategy with taxes in mind and planning for taxes is how do you reduce your taxable income? So I just talked about the standard deduction. We all get, if we're single, $16,100 of effectively untaxed income, or $32,200 if we're married filing jointly. That's great. There are other ways we can lower our taxable income. Saving into pre-tax retirement accounts, 401ks, 403bs, 457s, that lowers our taxable income. So if we're at 50,700 and we put $300 into a 403b instead of just taking in our paycheck, which we may not need the $300 to live on, we never go into the 22% bracket. Health savings account or flex spending accounts. More and more districts over time are moving to high deductible plans where you get a health savings account. They are the most tax efficient vehicle in the United States. It goes in pre-tax, it grows tax deferred, you take it out completely tax free. It is a great way to save yourself a boatload of money on taxes. Saving into a 529 plan. You don't get a federal tax deduction for this, but you can get a state tax deduction, which again, I've never found anyone that wants to pay more to New York State as well as the federal government. You can also make charitable donations. So even if you take the standard deduction for a single individual, they can write off up to $300 for charitable donations, or for a married couple, $600. So think about that. If I made $50,700 and I was $300 over the 22% tax bracket, wouldn't you rather give it to charity than give it to the IRS? And then the educator expense deduction. Every educator can write off $300 basically for their classroom, their building. And if you're married to both educators, you can both do that. Again, wouldn't you rather give money back to the kids, back to the school than to the IRS? Then there's common tax credits. It's not impossible to qualify for these, especially if you know what to look for when you're qualifying. And there is way more tax credits out there than we find people generally realize. I'm not going to go through what each and every one of these tax credits mean, but just know you get child tax credits, dependent tax credits, or dependent care tax credits. Those are ones I do find people are a little bit more familiar with, typically speaking. But you have the American Opportunities, the Lifetime Learning. You can even get the bottom one, the Savers Tax Credit. That's a new one where basically if you make under a certain amount and you save enough towards retirement, they give you an additional tax credit on top of that. So there's all these different tax credits out there, but you just have to know what to look for. And you can bring them to your CPA, your accountant, and say, like, hey, I was looking into this. Does this make sense for me? And they should be able to walk you through if that makes sense for you or not. Going into retirement accounts, and then I added the HSA into this. So just a good reminder here. Every district, you have pre-tax retirement accounts. You don't always have the HSA available. You might have an FSA, which is also pre-tax. These are ways you can lower your taxable income. Money goes in on a pre-tax basis. So you literally get a tax deduction for contributing. If I make $100,000, I contribute $5,000 to a 403b. I'm now taxed on $95,000, not $100,000. The money grows tax deferred, so you're not paying taxes as you gain interest, and you take it out in retirement and it's taxed at that time. Retirement accounts and health savings accounts are your best way to lower your income. What we often find is people are, they're working, they have kids, and all of a sudden their kids move out and they're not dependent anymore. And we look at their situation, they don't have dependents, so they're not getting the tax credit for that. They're not contributing to a 403B or 457. They have no deduction. So they're just donating more of their money to the IRS. These are an awesome way to save yourself money because you can use it in the future and not give it to the IRS. And there are also Roth accounts. Roth accounts don't help you today, but they will help you in the future. Money goes in after taxes, so it doesn't lower your taxes today. It grows tax deferred. You take it out in retirement, it's tax free. So just like we want to plan and save you taxes today, you want to save taxes in retirement. You can't just ignore your taxes in the future either. So looking at an example here, we have a gross annual income of 50,000. We'll assume that this person is a single filer. Their annual contribution is $3,000 to their 403B. That means their taxable income is 47,000. Let's say their effective tax rate, this would be federal plus state, is 15%. They're paying $7,050 to the federal government and the state in taxes. So they have a net income of about $39,950. Because they made this $3,000 contribution to their 403B or 457B or 401k, they would have saved $450 in taxes. So 15% times 3,000 is $450, which if you do that every year, year over year, obviously that can add up to some pretty large numbers. Also, just being that you're saving on a pre-tax basis, at the end of the day, the IRS wants people to save into their retirement accounts and health savings accounts. So if you're saving and you want to save $500 monthly, well, if you have $500 go into your paycheck and you just have it run through your paycheck, they're taking out federal and state income taxes, let's call that 25%. You're losing 25% of that money to taxes. So not only does it allow you to lower your taxable income, you can put money away for yourself for the future, and you don't have to budget for that amount because you're going to lose it to taxes. You can save more and have it feel like less, which is a huge, huge benefit. The IRS wants people to save for their retirement. They do it through giving you tax breaks. So if you're paying a lot in taxes, have you taken the time to really look at what am I contributing to my 403B or health savings account or 457B? And can I do more and help myself more for the future and on my current taxes today? Can't tell you how many times Kelly and I run into people and we look at it and it's like, hey, you're $1,000, you're $2,000 to getting to the lower tax bracket of the 12 or 22%. Do you think you can put in the extra amount, the $50 a pay, $100 a pay to lower your taxable income? And they're like, yeah, no problem. We can do that. But again, you have to know the rules. You have to know where you stand to play the game and save yourself the $450, the $500, the $1,000 in taxes. Doing that for 20 years, you might just save yourself $20,000 or $30,000. So again, planning for taxes is not just preparing your taxes, it's understanding, okay, where can we expect our taxes to end up this year, next year, and ongoing? And what can we do to save ourselves some money, which in each year might only be a couple hundred or a couple $1,000s. But again, you do that for a career, you save yourself a lot of money and you help yourself down the road. I won't go too far into this, but this is also just an example of saving Roth contributions. So as I've talked about, you can't just ignore future taxes as well. And when I say future taxes, long-term taxes, you got to make sure you're putting yourself in the right position down the road because people in the public setting are going to have large New York State pensions, assuming they have 20, 30 years in the system, plus their Social Security, plus their 457 or 403B. If you only have those income streams, you only have taxable accounts in retirement, taxable incomes in retirement. So you also want to make sure you're setting yourself up for the future to give yourself tax-free income. I never met the person that says I just had too much tax-free income in retirement. So what are the key points to remember? The biggest things is just looking at understanding how, at a baseline level, how the tax code actually works, or working with someone that understands and can help you walk you through it. Because it's not until you understand how the game works, can you then understand where do you fall in the game and what can you use to lower your taxable income, help yourself, and save yourself some money in taxes. How many people, like I've talked about, could have just contributed a little bit more and saved themselves 22% in the last $1,000 or $2,000 income, or they never used the educator deduction or just the charitable deduction. And sometimes those people are buying things for their classroom, buying things for their building, are making charitable deductions. They just never wrote it off. Or there was a tax credit they never knew they applied for, or they were filing single instead of head of household. Just talk with someone about it, see what you can do, because it might save you a couple $1,000s in taxes, and I'm pretty sure everyone would rather have that in their pocket than the IRS's pocket. If you'd like to talk with somebody, Kelly and I are always available. There's a Sanees members at equitable.com. You can email myself directly, Kelly directly, or email the Sanees email. We're happy to set up a time and just talk through it. Happy to look at for 2026, where might your taxes fall or in the future? And is there things you can start doing today? Because you do have to do them today to put yourself in a good bracket for 2026. And tax season is not over. Tax season goes to April 15th. There are still things you can do for 2025 to lower your tax brackets before the April 15th cutoff. So if you have any questions, always feel welcome to reach out. We'd be happy to set up a time to connect and just help you out however we can.